While the public focuses on the intelligence of new chatbots, the financial reality of this shift depends on industrial systems spinning in the background. Focusing exclusively on viral software overlooks the physical scale of the equipment required to make those tools function. History shows a distinct pattern. During the 19th century railroad boom, investors threw money at individual train operators, hoping to guess which company would dominate. We saw a similar trend during the internet era. Thousands of startups went public, generating intense market heat before their business models failed. Investors who secured durable returns targeted physical infrastructure, the routers, the fiber optic cables, and the hardware that made digital connectivity possible. Today's artificial intelligence cycle is following that same track. The consumer-facing software grabs our attention, but the foundational layer underneath it is where capital is quietly accumulating. Think about the California gold rush. The miners who abandoned their lives to dig in the dirt rarely found enough gold to break even. The men who opened the hardware stores to sell them tools, however, built sprawling enterprises. Investors call this the pick and shovel strategy. Instead of guessing which individual prospector will strike it rich, the focus shifts to universal suppliers. In the AI boom, software companies will compete and fail, but all require the exact same physical resources to operate. To find the modern equivalent of those hardware stores, we have to look past the text on our screens and trace the technology downward. The initial wave of public discovery focused on what large language models could do. Now, we are entering a phase of commercial implementation. Right now, logistics companies are using predictive models to optimize their trucking fleets. Hospitals are automating thousands of hours of administrative paperwork. Manufacturing plants are deploying sensors to predict equipment failures before a machine ever breaks down. The software architects and data engineers building these specific pipelines are creating measurable savings for traditional businesses. This happened during the smartphone era, where component suppliers for glass screens and cellular network towers captured the initial gains of the mobile revolution. The businesses integrating artificial intelligence into the broader economy represent the first layer of value operating out of the public eye, but they still rely on something deeper. Every time an automated system reviews a legal contract or generates a medical summary, it executes billions of calculations. Software requires physical hardware to exist. Those calculations happen inside massive, windowless warehouses. These are data centers packed with specialized silicon chips, high-speed networking cables, and heavy-duty cooling systems. These facilities are the central nervous system of the digital economy. And right now, global capacity is struggling to keep pace with corporate demand for computing power. Physical hardware dictates the speed at which AI can be deployed, giving the manufacturers of these components significant pricing power. Yet even the most advanced silicon chip is useless without the raw electrical current required to power it. This is the reality that caught many analysts off guard. Training and running these new models requires an unprecedented amount of electricity. Because of this demand, utility operators and companies building grid modernization equipment have become essential components of the AI ecosystem. It is the same dynamic that played out during the Industrial Revolution, where modern manufacturing was completely tethered to the output of early power plants. AI is an energy problem. Without modernized electrical grids to support those data centers, the entire system grinds to a halt. Map out the entire vertical stack, from the energy grid through data centers to consumer applications, and a clear picture emerges. Consumer brands may fluctuate, competing for dominance, but the bottom three layers must continuously expand to support that competition. Investing in this infrastructure isn't a straight line. There will be periods of high volatility and market corrections as sentiment shifts, but technological adoption doesn't stop because of market sentiment. Businesses will continue integrating these tools to reduce costs, regardless of short-term price swings. Long-term results come from identifying essential infrastructure and holding it through the inevitable periods of uncertainty. To evaluate this space logically, ask yourself three questions. Is this product indispensable? Does this business solve a real-world problem? And do I have the patience to hold it as the market matures? Investors who navigated the late 90s didn't panic when consumer bubbles burst. They focused on the foundational layers of the internet while hype faded. So instead of asking which stock will generate a quick return, Ask yourself, what specific physical products become entirely indispensable if artificial intelligence becomes a permanent part of the global economy? The durable growth of the next decade may reside in the unglamorous physical systems quietly powering the world right in front of us.